Alright, so here's the solution to exam number 1 for chapters 14, 15, and 16. Problem number 1. Now the first thing what I do when I approach a multiple choice question, especially when it is a problem-oriented question, is I read the last sentence so I know exactly what I need to do before I go and read the material, the rest of the problem. And it says, using the effective interest method of amortization, interest expense for 2017 is, and so what I'm trying to do here is calculate interest expense for 2017 for this bond payable. So now I'll go back and read the problem. On January 1st, 2017, Huber Company sold 12% bonds with a face value of $2 million. The bonds mature in 5 years and interest is payable semi-annually. So twice a year they pay interest on June 30th and December 31st. And the bonds were sold for $2,154,500. So they told me the sales price, so I know it has a premium of $154,500. And now I'm going to use the effective interest method to calculate interest. And how do we do that? Well, we take the yield or market rate times the carrying value at the beginning of the period times the time period. So they gave me my carrying value at the beginning of a period. There's my yield rate. And they pay every 6 months, so 6/12. So my first interest payment is $107,725. All right, now my carrying value is going to change, and it's going to change by the difference between the cash payment and the interest expense as calculated. So up above here, I calculated the cash payment for 6 months, $2 million face value times the stated rate times the time period 6/12. And so cash payment is $120,000. Interest expense is $107,725. That gives me a difference of $12,200. This is 25. $12,275. All right, so this is my carrying value is going to decrease by this amount after 6 months. There's my beginning carrying value. There's my decrease. There's my new carrying value. Now for the second 6 months, we take our yield times the carrying value at the beginning of this 6-month period times the time period. And when I add those together, I get total interest expense for the year of $214,836. All right, let's go on to the next one, which is labeled here problem number 3. And again, I start out by reading the last sentence so I know what they want before I read the details of the problem. And the question says, what amount did Spear receive from the bond issue? So here, go up now and read. On July 1st, 2018, Spear Company issued 4,000 of its 10% $1,000 bonds at 99 plus accrued interest. The bonds are dated April 1st. So they're dated after their original creation date by how many months? Well, April, May, and June, 3 months. So there is 3 months of accrued interest that we're going to have to collect from those investors when they purchase the bonds. So I'm going to receive, they're sold at 99, 4,000 bonds, $1,000 face value, sold at 99. So they sold for $3,960,000. And then the interest I collect, face value times stated rate, okay, times time period. And we already said it's 3 months of 12 we have to collect accrued interest. That gives me $100,000. So add them together and we will receive a total cash of $4,060,000.